Hi, it's Glenn here from Gold Survival Guide. Today, the topic, what would negative interest rates mean for New Zealand? A couple of weeks ago we reported on the prospect of negative interest rates arriving in New Zealand as soon as November. We've actually been talking about negative interest rates being a possibility since way back in May 2018. But now it's looking a bit more like a case of when, not if. A couple of weeks ago, here's what we reported. That this is the Westpac chief economist saying, Stevens is the Westpac chief economist, expects the RBNZ to cut its change of plan in its August monetary policy statement and make a 75-point cut to negative 0.5% in November. When the RBNZ on 16th of March cut the OCR from 1 to 0.25, the Deputy Governor told interest.co.nz in a live interview that not all trading bank systems were ready to deal with negative interest rates. He compared the situation to that at the change of the millennium when people were concerned about how IT systems would respond to the date ticking over from 99 to 00. Yet Stevens said holding off on a negative OCR until November should get around that, but the timing of the RBNZ's move will depend on how long it takes trading banks to prepare, which is uncertain. So, yeah, as we said then, technology looks to be the main stumbling block currently. But anyway, as a result of what we had there, we've had a few questions in from readers on the topic of negative interest rates. So today we're going to have a crack at answering them. So first up, we had this one from Paul. Hi, what would negative interest rates mean for NZ? What does that actually mean? Would I be paying to store money at the bank? So first we might be worthwhile us looking at what are negative interest rates exactly. So that's the rate, the rate being referred to is the rate set by a central bank. So in our case, in New Zealand, it's called the official cash rate, or OCR, and it's the rate that commercial or retail banks are charged by the Reserve Bank of New Zealand for keeping excess reserves with the Reserve Bank. So in other words, the reserves that banks don't want to lend out at that moment. And the theory is that by making this rate negative, it will encourage banks to lend money out to customers, as they won't want to lose money by keeping the excess reserves with the central bank. And so this should stave off deflation and keep the money around going. It doesn't necessarily mean that the retail deposit holders, aka Average Joe and Joanna Saver, are charged to keep savings in the bank, although that is a possibility. It would depend on how low the negative interest rates got. If they got low enough that the banks may then choose to pass this on to customers by also charging the retail customers the negative interest rates on their deposits, effectively charging them to keep money in the bank. And in some European countries where there have been negative interest rates as far back as 2012, then some larger commercial deposit holders have been charged to hold cash with the bank. If we look over here, for example, this is from last year. Banks start to crack under negative interest rates as Danish deposits hit record, and it talks about here how Danish banks have enjoyed negative interest rates longer than anyone else, and they're now finally buckling under the pressure. And a second systemically important financial institution in Denmark said it will impose a rate of minus 0.6% on retail deposits bigger than 1.1 million US dollars, and the announcement by Sydbank came roughly a week after Bank said it would do the same. And then Sydbank's chief executive Karen Frosick said she never expected negative interest rates to last this long. I thought it would be over quickly. It wasn't, she said. So there, that's one example. We've also got another example over here where in Germany some retail deposit holders are being charged to keep deposits with some banks as well. So this is actually retail customers, not just the big institutions and large clients. And so this is a growing number of banks in Germany are charging retail customers negative interest rates, starting with the very first euro deposited into their accounts. At least 3 German banks are reportedly doing so, with more expected to follow suit in the near future. As the central bank maintains a negative rate policy, more banks say they're finding it necessary to pass on the negative rate burden to their customers. So, I guess back to that question, would I be paying to store money at the bank? Not necessarily, but it does show that it's already happening around the world. And here's another bit of bizarreness. There's also the potential for retail customers to be paid to actually have a mortgage. And this has happened in the likes of Denmark, and we reported about this back last year in June too. Could negative interest rates be in store for New Zealand? And here we said how homeowners in Denmark are about to get negative interest rates on their loans for all maturities through to 5 years, representing multiple all-time lows for borrowing costs. So effectively, it's not quite effectively that you're getting paid to have a mortgage, because I think this article goes on to say with fees and other things, you're not actually receiving money from the bank, but effectively over there in Denmark there are some mortgages where they're really not paying any interest. So yeah, I mean, I guess it does show how perverse things have gotten by leaving it up to a few people to control what is the price of money, which are interest rates. So let's have a look at another question. This one from Tony. If the RBNZ goes into negative interest rates, will it need to ban cash first? So the short answer there really is no, they wouldn't. There's already precedents for this in that other countries that already have negative interest rates, and they haven't had to ban cash first, because the aim of negative interest rates is actually to encourage banks to lend. That's the first aim. So the central bank sends its main lending rate to be negative, so banks are charged to hold money with the central bank in the short term, and the aim of that is that the banks will then instead choose to lend out to the customers rather than holding excess reserves with the central bank. But of course the banning or removal of cash is not necessarily a crazy idea. Well, it's not a crazy idea from the central planner's perspective, at least anyway, as this would mean negative interest rates could also be set for customer saving deposits with the retail banks, because the aim would be to get people spending money rather than saving it. So the idea is to get money circulating and increase inflation. So, and if this were to occur, then people would obviously withdraw money from the bank and hold cash instead. They'd effectively stuff the money, in their mattresses, because 0% return is better than, say, -1 or -2%. So the removal of cash from the system, the banning of cash, that would also remove the escape mechanism from negative interest rates on bank savings accounts. So yeah, it makes sense in many ways, and it's not to say it won't happen, but it's not to say that it's actually necessary. It's not a necessary precursor before moving to negative interest rates. But of course there still exists another escape mechanism, and that would be buying gold or silver to protect your purchasing power and to hold that as an alternative to holding cash. But actually the other thing is that it doesn't actually require negative interest rates to be set by the central bank in order for you to be losing money, because like here in New Zealand, interest rates are actually already negative in real terms. And if we go over here, we can see this article we wrote towards the end of last year. real interest rates versus gold prices. And if we scroll down here a bit, and just look at what real interest rates mean, it's just the short-term interbank lending rate minus the year-on-year growth rate in the consumer price index. So yeah, so basically the difference between the two, and the difference at the moment, as we can see in this chart here, where the blue section is the real interest rate and the gold is the gold price. This is obviously a few months out of date now because it's from the end of 2019, but we can see here that gold prices have been dipped down into negative, and they've actually, sorry, not gold prices, real interest rates have dipped down into negative, and they have been dropping here since right back in 2015, which not totally coincidentally we'd say is when the gold price started to turn back up again, and it's been heading up, and down here this has been heading down, and these real interest rates are probably even more negative now than when this chart was last done. And so a question actually just in today also ties in quite nicely to this topic of real interest rates too, and it's this one here. One question out of many I have is, are my savings in the bank keeping up with inflation, or am I losing money? Annual inflation in New Zealand has increased to 2.5% in the first quarter of 2020 from 1.9% in the previous 3 months. If the savings in my bank account is gaining the interest of, let's say, 2.5%, and the inflation rate is 2.5%, am I gaining any interest while the nation's currency is being devalued on top of inflation? So, am I losing money by saving? We're definitely not gaining anything, because firstly, looking at these numbers here, the 2.5% interest rate, also you have to remember actually has to have withholding tax taken out of it. So for most people that's going to be 20% at least, depending upon your tax rate. So straight away taking 20% off that rate, and your 2.5% is down to 2%. So straight away at that basis, your returns are negative basically. If you're only getting 2.5% minus the extra 0.5 down to 2% after you take tax off, and CPI, as the question holder says, is just ticked up to 2.5% in the first quarter of this year, so you're at negative 0.5%. But then on top of this, you're also missing out on the potential returns elsewhere, or what's known in economics as the opportunity cost. And so gold's actually been going steadily up since 2014. If we jump over to our chart here, we can see down here in 2014 gold was down around the 1400 to 1500 mark, down through this period here, and so we're now right up into the high 2000s, getting close to 3000, let's call it 2900. So effectively the gold price in New Zealand dollars has actually pretty much doubled since then, whereas yeah, you've been getting pretty minimal returns in the bank if anything, and now up in this phase in here you're actually effectively what this reader is really talking about is that real interest rates have now gone negative, even though the nominal or central bank set interest rate isn't negative. Real interest rates, or your after inflation return, has actually gone negative, and that's probably one of the reasons why we've seen this large move up in gold and New Zealand dollars over the last year or so. Yeah, so any funds in the bank are effectively missing out on those returns too. So yeah, hopefully that has helped explain a little bit about what negative interest rates might mean for New Zealand. And as I said earlier, it seems to us that this is likely more a case of when rather than if. We've been talking about this since right back in 2018 and saying it was a possibility. mainly because the Reserve Bank's actually been talking about it quite openly since right the way back then too. So we'd say negative interest rates are definitely on the cards. Um, with them, it's likely that the real interest rates are likely to go more negative, or to continue to at least stay negative uh, compared to what they are currently. And so, quite likely, I would say this trend here will continue, where we're going to see the gold price continue to rise, because that's what gold is. One of the things it's best correlated with is negative real interest rates. So, while we've seen a good rise through here, it seems pretty likely, if you extrapolate out where the pointy head central planners are going, we're going to the government's going to spend more money, and the central bank is probably going to continue to print more money, or currency rather, and quantitative easing is likely to continue. They're likely to have to do more extreme things such as negative interest rates, and so it's likely that more money is going to find its way into gold and likely into silver. And so my my best guess would be that we're likely to see this rising trend of gold continue into the future for some time yet. So yeah, so hopefully that's been a good summary of what the impact of negative interest rates in New Zealand might mean. Subscribe if you're on YouTube. Subscribe for further updates from us, and or otherwise head over to our website and sign up for our newsletter updates and be kept up to date with what's going on in the world of precious metals. Thanks for tuning in again. This is Glenn from Gold Survival Guide. Thanks.